Here's a question that sounds simple, but trips up almost everyone. Is your car an asset? Most people say yes without thinking twice. Of course it's an asset. You own it. It has value. You could sell it tomorrow and get money for it. It's in your driveway. It's in your name. It's yours. How could it not be an asset? Here's the uncomfortable truth. By the definition wealthy people actually use, it's probably not. And once you understand why, you're going to look at every single purchase in your life completely differently. You're going to look at your car differently. You're going to look at your house differently. You're going to look at your phone, your clothes, your furniture, your entire life differently. And that shift in perspective is worth more than any stock tip, any real estate deal, any business idea anyone has ever given you. Today, we're breaking down the one distinction that quietly separates people who build real wealth from people who just accumulate expensive stuff. The real, actual, no BS difference between an asset and a liability. Not the textbook definition, not the accounting definition, the functional definition, the one that actually determines whether you're getting richer or poorer with every dollar you spend. Let's start with the definition almost nobody actually uses correctly. In everyday language, in casual conversation, an asset is just something valuable you own. Your car is an asset, your house is an asset, your jewelry is an asset, your furniture is an asset. If it has a price tag, if someone would pay you money for it, it's an asset. That's how most people think, and that's why most people stay broke. Because in real financial terms, the terms accountants, investors, business owners, and wealthy individuals actually operate by, the definition is completely different, and it's much simpler than you'd expect. An asset is something that puts money into your pocket over time. A liability is something that takes money out of your pocket over time. That's it. That's the entire definition. Not, does it have value? Not, do you own it? Not, could you sell it? The only question that matters is which direction is the money flowing? Is it flowing toward you or away from you? Month after month, year after year, is this thing feeding you or are you feeding it? That single distinction changes everything. It means value in ownership have almost nothing to do with whether something is actually building your wealth. You can own something worth $100,000 and be poorer every single month because of it. And you can own something that cost you almost nothing and be richer every single month because of it. The price tag is irrelevant. The ownership is irrelevant. The cash flow direction is everything. Let's test this with your car, since that's where most people first encounter this idea and feel the cognitive dissonance. You own it. It has resale value. It feels like an asset. You paid $30,000, $40,000, $50,000 for it. It's yours. It's in your name. It's an asset, right? Wrong. Run the test. Does it put money into your pocket or take money out? Every single month, it costs you insurance, $200, $300, maybe $400. Fuel, $200, $300, depending on how much you drive. Maintenance, oil changes, tires, brakes, unexpected repairs. Average it out and you're looking at another $100 to $200 a month. And if it's financed, which most cars are, you've got a loan payment of $400, $500, $600, $700 a month. Add it all up, and that car is pulling $1,000 to $1,500 out of your pocket every single month. And its value, the thing you paid all that money for, is dropping every single year through depreciation. 20% the first year, 10% every year after. 5 years from now, it's worth half of what you paid. 10 years from now, it's worth almost nothing. By the actual financial definition, a car is a liability, a costly one.
because money consistently flows out of your pocket to maintain and own it, and its resale value is shrinking the entire time you have it. You are feeding it. It is not feeding you. Every month, you write checks to the insurance company, the gas station, the mechanic, the bank. The car writes you nothing. It gives you transportation, sure. It gives you convenience. It gives you comfort. Those are real benefits, but they are not cash flow. And cash flow is the only thing that builds wealth. Now let's talk about the house, because this is where it gets genuinely controversial. This is where people get emotional. This is where people get defensive. Because in America, homeownership is treated as sacred. It's the American dream. It's what your parents did. It's what everyone tells you to do. Stop throwing money away on rent. Buy a house. It's your biggest asset. It's your retirement plan. It's your wealth. But run the same test. Does your primary residence put money into your pocket every month or take money out? Between the mortgage payment, the property taxes, the homeowner's insurance, the maintenance, the repairs, the HOA fees, the landscaping, the new roof you'll need in 15 years, the water heater that dies in year 8, the furnace that goes in year 12, a primary home is very often a significant monthly outflow, not an inflow. Money is leaving your pocket every single month and going into the house. The house is not writing you checks, you are writing it checks. Now, that doesn't mean buying a home is a bad decision. I want to be very clear about this. It can build long-term value through appreciation. In many markets, homes double or triple in value over 20 or 30 years. And eventually, if you stay long enough, the mortgage gets paid off and your housing cost drops dramatically. And it provides a place to live that you're not paying rent for, which has real psychological and practical value. Stability, roots, a place that's yours. Those things matter. They're not nothing. But by the strict cash flow definition, most primary homes function financially more like a liability during the years you're living in them and paying for them, even while their overall value may be slowly growing in the background. You're feeding the house for 20 or 30 years, and maybe at the end, the house gives you something back when you sell it. But for those 20 or 30 years, the money is flowing out, not in, and that's the definition of a liability. Compare that to a rental property that generates positive monthly cash flow. You buy a property for $200,000. The mortgage, taxes, insurance, and maintenance cost you $1,500 a month. You rent it out for $2,000 a month. $500 flows into your pocket every single month. That property is feeding you. It's putting money in your pocket while you sleep. By the real definition, that's a genuine asset. Not because it's real estate, not because it's a building, but specifically because of the direction the money is flowing toward you every month, consistently, reliably, whether you show up or not. And this is the mental shift that changes everything. It's not about what category something falls into. It's not about whether it's real estate, or a vehicle, or a stock, or a business, or a piece of art. It's not about whether it's expensive or cheap, impressive or ordinary, traditional or unconventional. It's about the direction of cash flow. That's the only question. Is money coming to you or going from you? Dividend-paying stocks that pay you money each quarter. Asset. You bought them, and now they send you a check every 3 months. You did nothing. You showed up nowhere. The money arrived. That's an asset. A rental property generating positive monthly income. Asset. The tenant pays the mortgage, covers the expenses, and puts surplus in your pocket. You own it, and it feeds you. A business that generates profit without requiring your constant presence. Asset. You built it, you systematized it, and now it produces cash whether you're there on Tuesday or not. That's an asset. A piece of intellectual property, a book, a course, a patent, a song that earns royalties. Asset. You created it once, and it pays you repeatedly, indefinitely, with no additional effort. That's an asset. Meanwhile, a boat sitting in a driveway, costing you storage fees, insurance, maintenance, and fuel for the 6 weekends a year you actually use it. Liability. A wardrobe of designer clothing that's losing value the moment you wear it, liability. An oversized mortgage on a home stretching your budget so thin you can't invest a single dollar, liability. A financed luxury vehicle with a $700 payment and a $300 insurance bill, liability. A timeshare you can't get rid of, liability. A country club membership you feel obligated to maintain, liability.
These are liabilities regardless of how expensive or impressive they look, regardless of what your neighbors think, regardless of what Instagram tells you success looks like, because they consistently take money out of your pocket without ever putting money back in. They are holes in your financial bucket, and no matter how much water you pour in, if the holes are big enough, the bucket never fills. Let's talk about why this distinction matters so much for actually building wealth, not theoretically, not academically, practically, in your actual life, in your actual bank account, in your actual future. Wealthy individuals, on average, don't necessarily earn more income than everyone assumes. There are plenty of high earners who are broke, plenty of doctors, lawyers, and executives who make $300,000, $400,000, $500,000 a year and have almost nothing to show for it, because they direct their money toward liabilities that look like assets. The bigger house, the nicer car, the private school, the vacation home they use twice a year, the boat, the watches, the clothes, all of it pulling money out, all of it requiring more income to sustain, all of it keeping them trapped on the hamster wheel, earning more just to maintain the performance. Many actual wealthy people simply direct a larger share of their money toward acquiring genuine assets instead of liabilities. And here's the part that compounds over time, the part that makes this truly powerful, truly transformative, almost magical in its effect. Assets, once acquired, often start funding the acquisition of even more assets. Think about this. You buy dividend-paying stocks. Those stocks pay you dividends every quarter. You take those dividends and reinvest them into more dividend-paying stocks. Now you have more stocks, which pay you more dividends, which buy you even more stocks. The snowball grows. You didn't add any new money from your paycheck. The asset funded the next asset. The machine is building itself. You buy a rental property. The rental income covers the mortgage, the taxes, the insurance, the maintenance, and leaves you with $300, $400, $500 a month in surplus. You save that surplus for 2 or 3 years, and now you have a down payment for a second property. The second property generates its own surplus. Now you have 2 income streams funding a third, then a fourth, then a fifth. You didn't need a raise. You didn't need a second job. The assets funded the assets. The snowball rolls downhill and gets bigger and faster with every turn. That surplus creates a compounding snowball effect. Assets generating enough cash flow to purchase more assets, entirely separate from your day job's income. Your salary becomes irrelevant to your wealth building. Your assets are building your wealth. Your salary is just covering your groceries. Liabilities do the exact opposite. They require your income to sustain them, month after month, year after year. And that income becomes trapped servicing the liability instead of being redirected towards something that builds wealth. The car payment doesn't build anything. The oversized mortgage doesn't build anything. The boat insurance doesn't build anything. They consume, they drain, they take, and they never give back. They never fund the next purchase. They never generate surplus. They just take and take and take, until you're 60 years old wondering where all the money went. This is why someone earning a modest income who consistently buys real assets can end up with more actual wealth than someone earning significantly more who consistently buys liabilities, because one person's money is working for them and the other person's money is working against them. No matter how large the paycheck is, no matter how impressive the title is, no matter how big the house is, the direction of the flow is what determines the outcome, always, without exception.
Let's make this real with a detailed comparison. Two people, same income, same surplus, completely different choices, completely different futures. Imagine two people, each with an extra $500 a month in disposable income. $500. That's it. Not a fortune, not a windfall, just $500 a month that isn't spoken for. The first person uses that $500 as a car payment on a newer vehicle, a nice vehicle, an impressive vehicle, a vehicle that makes them feel successful when they pull into the office parking lot. But it's a liability. It's steadily losing value. It requires ongoing insurance and maintenance costs on top of the payment itself. The $500 is just the loan. The real cost is closer to $800 or $900 a month when you add everything in. Over 10 years, that person has spent $60,000 on the loan alone, plus another $20,000 or $30,000 on insurance, fuel, and maintenance. $80,000 to $90,000 total. And at the end of those 10 years, they have a car worth maybe $12,000 or $15,000. They spent $90,000. They have $15,000. The liability consumed $75,000 of their life energy and gave them back a depreciating machine. The second person invests that same $500 a month into a diversified, low-cost stock index fund. No drama, no excitement, no Instagram post, just an automatic transfer every month into a fund that tracks the entire market. Assuming a historical average return around 7% annually after inflation, that consistent monthly investment could realistically grow to roughly $85,000 to $90,000 over that same 10-year period. And here's the critical difference. At the end of 10 years, the first person has a car worth $15,000 that will be worth $5,000 in 5 more years. The second person has $90,000 in an asset that will continue growing whether they add more money or not. The asset keeps working. The liability keeps dying.
And if you extend that timeline to 20 years, the gap becomes almost absurd. The car person has spent $180,000 and has a 10-year-old car worth almost nothing. The investor has over $260,000 in a growing portfolio. Same $500 a month, same 20 years. One direction built wealth, the other direction destroyed it, and neither person earned a dollar more than the other. That gap, spending $500 a month on a depreciating liability versus investing that same $500 into an appreciating asset, is the entire difference between two completely different financial futures, and it has nothing to do with how much either person earns. Nothing. It has everything to do with where they direct the money, the flow, the direction, the choice. Now, this doesn't mean you should never buy things that don't generate income. I want to be very clear about this, because this is where people take the idea too far and turn it into a prison. Life isn't only about optimizing every dollar toward wealth building. Comfort matters. Enjoyment matters. Quality of life matters. Experiences matter. Buying your kid a bicycle isn't a liability problem. Taking a vacation isn't a financial crime. Enjoying a nice dinner isn't a moral failure. You're allowed to spend money on things that make your life better without generating a cash return. But the framework becomes powerful when you use it consciously as a filter before major purchases, rather than ignoring it completely. As a lens you hold up before you spend, not a rule book that punishes you for being human. Ask yourself, before a big purchase, is this going to put money into my pocket over time, or take money out? Neither answer is automatically wrong. You're allowed to buy the thing that takes money out. You're allowed to want the nice car, the bigger house, the boat, the trip. But knowing which one you're choosing, and choosing it on purpose, with full awareness of what it costs you over time, is what separates intentional spending from accidental financial drift. The person who buys the car, knowing it's a liability and deciding it's worth it for their life, is making a conscious choice. The person who buys the car thinking it's an investment, thinking it's building wealth, thinking it's a smart financial move, is lying to themselves. And that lie compounds just as powerfully as the truth does.
Let's talk about the lifestyle upgrade funded by assets concept, because this is where the wealthy truly separate themselves from everyone else. Most people fund their lifestyle upgrades directly out of their paycheck. They get a raise, they buy a nicer car. They get a bonus, they renovate the kitchen. They earn more, they spend more. The lifestyle inflates in lockstep with the income, and the surplus never materializes, and the assets never get built, and the freedom never arrives.
The wealthy do it in reverse. They build the asset first. They let the asset generate the cash flow, and then they use that cash flow to fund the lifestyle upgrade. They don't buy the vacation home out of their salary. They buy the rental properties first, let them generate surplus for a few years, and then use that surplus to buy the vacation home in cash. They don't finance the luxury car out of their paycheck. They build the dividend portfolio first, and then use the dividend income to pay for the car. The asset funds the lifestyle, the paycheck funds the life, and the two never cross. This means the lifestyle upgrade is free. Not free in the sense that it cost nothing, free in the sense that it didn't cost you your future, it didn't come out of your retirement, it didn't come out of your freedom, it came out of the surplus your assets generated. You got the thing and you kept the future. You got the car and you kept the portfolio. You got the vacation and you kept the security. That's the game. That's the actual game wealthy people are playing, and it's available to anyone who understands the direction of the flow. Here's the framework to take with you. 5 rules. Make them your filter. Make them your lens. Make them the questions you ask before every significant financial decision from this day forward. Rule 1. Define assets by cash flow direction, not by how expensive or impressive something looks. A $50,000 car is not an asset. A $5,000 dividend portfolio is. The price tag is irrelevant. The direction of the flow is everything. Stop confusing cost with value. Stop confusing ownership with wealth. Ask the question, is this feeding me or am I feeding it? Rule 2. Before a major purchase, ask honestly whether it will put money in your pocket or take money out, and make the decision consciously either way. You don't have to say no, you just have to know what you're saying yes to. If it's a liability, own it. Say, I'm choosing to spend this money on something that will cost me over time, and I'm okay with that. That's a conscious choice. That's power. What's not power is pretending a liability is an investment. What's not power is lying to yourself about what you're actually doing. Rule 3. Prioritize directing surplus income toward genuine assets before liabilities, especially early in your financial life, because assets compound and liabilities drain. Every dollar you put into an asset in your 20s or 30s is worth exponentially more than a dollar put in during your 50s because of the time it has to grow. And every dollar you put into a liability in your 20s or 30s is a dollar that will never compound, never grow, never fund your freedom. The early years matter most. Protect them. Direct the flow toward assets first. Let the liabilities wait. Rule 4. Understand that even traditionally safe purchases like a primary home can function more like a liability in the short term, and plan your finances with that reality in mind, rather than assuming ownership alone equals wealth. Don't put all your money into the house and call yourself wealthy. Don't ignore your retirement accounts because the house is my retirement. The house is a place to live. It might appreciate, it might build equity, but it's not feeding you monthly cash flow. It's not compounding in a brokerage account. It's not generating dividends. Plan accordingly. Build real assets alongside the house, not instead of them. And Rule 5. Let assets fund your lifestyle upgrades over time, rather than financing lifestyle upgrades directly out of your paycheck. Build the machine first. Let the machine generate the surplus. Then use the surplus to buy the thing. The car, the vacation, the renovation, the upgrade. Let the assets pay for it. Let the portfolio fund the lifestyle. Let the rental income buy the boat. That way, you get the thing, and you keep the future.
You get the upgrade and you keep the freedom. You get both. And that's the whole point. This is the actual mental model behind almost every wealth-building strategy that exists. Dividend investing, rental real estate, business ownership, intellectual property, royalties. Different vehicles, different strategies, different levels of complexity, but the same underlying principle, the same fundamental truth, the same unbreakable law. Acquire things that pay you and be deliberate about anything that only costs you. That's it. That's the entire game. Everything else is detail. Everything else is tactics. The strategy is the direction of the flow. So here's my question for you, and I want you to actually do this exercise. Not just think about it, actually do it. Take a piece of paper, write down everything you own that has significant value. Your car, your house, your investments, your business, your jewelry, your electronics, everything. And next to each item, write one word: asset or liability. Does it put money in your pocket or take money out? Be honest. Be brutal. Don't give yourself credit for things that feel like assets but aren't. Don't let emotion override the math. When you're done, look at the list. How much of what you own is actually an asset by this definition, and how much of it is a liability wearing an asset's disguise? How much of your wealth is actually just expensive debt with a nice paint job? The answer might be uncomfortable, it might be confronting, but it's also the most liberating thing you can do. Because once you see the truth, you can change the direction. You can redirect the flow. You can start feeding yourself instead of feeding your stuff. Comment below and tell me what you found. How much of your life is asset and how much is liability? I read every comment and I genuinely want to know. Subscribe to the Violet Vault. Hit the notification bell, because next time we're breaking down another core money principle that changes the way you see every financial decision in front of you. We don't do surface level advice here. We don't do hype. We do the foundational thinking that actually rewires how you relate to money. And if that's what you need, you're in the right place. Because remember, it was never about how much you own. It was never about the size of your house, the brand of your car, or the price tag on your life. It was always about which direction your money is actually flowing, toward you or away from you, building your future or funding someone else's. The flow is everything, and once you see it, you can never unsee it. Thanks for watching the Violet Vault. I'll see you in the next one.